we are joined right now by Duncan Bourne, Managing Director of Wynnchurch Capital. Duncan, thank you so much for joining us today.
Thank you for having me.
Tell us a little bit about your company. You're based in Chicago.
Yeah, we're based in Chicago. We're a private equity firm. We're a firm that invests in middle market companies, typically in North America, companies that are headquartered in North America, but they can have operations anywhere around the globe. They tend to be industrial or manufacturing or services businesses that, as I said, in the middle market space. And we invest in companies all the way from really super performing companies with great management teams to merely troubled or underperforming companies, all the way to deep, severe distress. I mean, high or very large negative EBITDA types of performing companies that we have an interest in investing in and turning those businesses around and making them better and creating value for our limited partner investors.
And to do that effectively from a philosophical standpoint, it sounds like it's very important to your company to be in close proximity so you can stay in contact with these companies you're trying to help.
Absolutely. So that's one of the reasons, that's a big reason, I think probably the major reason why we acquire companies that are headquartered in North America, so that we can get on a plane and go visit with the management groups that run those businesses. It's tough if you want to have a more hands-on approach to fixing companies or helping companies do better. It's tough if they're overseas. You know, you have to spend a day or two to get over there, and that's a severe waste of time as far as I'm concerned. And I don't think there's any real replacement for sitting down face-to-face across the table with the folks that you're working with to create value.
A lot of problems with these companies that are in distress. The reason that they're in distress is because they've mismanaged their company. So what sets your company apart when they're out shopping? You know, a lot of these companies just want more money.
Right. That's what I've seen typically is when a company falls into difficulty, the management team tends to say, well, I think I can fix this. All I need is a little bit more time, a little bit more money. And so often their entreaties are to the capital markets are to, you know, get a bigger loan or get somebody else to come in and give them a little bit more money to operate with. Well, what we try to look at is, well, what is the underlying reason? What's the underlying cause for this difficulty, this liquidity situation or illiquidity situation that these companies are into? So we say, well, look, we are interested in helping the management group. We like to either supplement them or work with them very closely to help them turn their operations around. So we're looking for not just capital, which we have, but we also have folks that are very interested in and also do hands-on help with the management groups at these companies.
What sectors mostly do you deal with?
Well, we're middle market, and so I sort of define that as anywhere from 10 million to $1 billion in revenue. Our fund size, we just finished raising our fourth fund, which is we're now able to invest out of. It's about a $1.3 billion fund. Our prior fund is a $600 million fund, and we still have some capital there for add-on investments in our portfolio. But what differentiates us, or where we like to play, is in North America, as I said. We also have a strong Canadian presence. A lot of U.S.-based funds don't have that presence. We have a guy in Toronto. We reach across the provinces of Canada and invest across there. About a quarter of our deals are up there. We also like manufacturing companies, industrial businesses, services companies that sort of serve those industries in general. We like companies that sort of have a hand in making tangible things.
You gave great insight earlier today on a panel, what's hot, what's not, areas to invest in. So what is your perspective of what areas are hot and not, and to what do you think the trend will be for the rest of the year and going into 2016?
Well, the big hot area now that everybody's been talking about is oil.
Of course.
And because of the huge decrease in price, it's a roughly 50% decline in price in less than a year. It's pretty dramatic, and it's having a huge effect on the services businesses and manufacturing businesses that supply equipment to that space. It's obviously certainly providing a huge effect to the E&P companies, the guys that are actually getting the oil out of the ground. So that's a big hot area, and certainly we're interested in that. I think there's other areas though that are in the U.S. Which are interesting to us. There's ag equipment, there's mining equipment, heavy equipment in the construction space, and other areas. We've historically done a lot of work in the automotive space, and we remain interested there. So there's always opportunity in sort of any industry sector that you take, as long as you're somebody that's interested in helping that business get better. So you can take an underperformer, for example, might have some issues with its capital structure, but not severe. but you can acquire that business and create a lot of value for your investors. So we're interested in a pretty wide swath of different sectors. But as far as restructuring goes, as far as distress goes, I think oil and gas is going to be it's going to be a very interesting area for a lot of folks for a couple of years.
It certainly is. Okay, Duncan, thank you. Great insight. Thank you for joining us today.
All right, thank you very much.